going to talk to you guys about some of the trends going on in the insurance world right now. Everyone's probably dealt with increased premiums and all different types of claims and stuff that have been related. So Ryan began his career in the high net worth insurance space in 2008. He's held various roles with underwriting and sales, partnering with agencies that he has found unique solutions. It's one of the benefits that he enjoys of his job. An avid learner, Ryan has obtained his chartered property and casualty underwriting, association and risk management, chartered private risk and insurance advisor, and a designated Toastmaster. Currently, he's enrolled at Wharton Executive Education Program at the University of Pennsylvania, and also working to obtain his Certified Advisor of Personal Insurance. Without further ado, Ryan.
Appreciate it. Well, thank you, everybody. I'm excited to be here today. You can tell a little bit by my background. I am a little bit of an insurance nerd, so if I get a little too passionate today, you might just have to stick with me. And I do want to throw it out there. I am with Chubb Insurance. I do not make the rates, nor do I make the products, so please be nice to me today. But we're going to talk about a topic today that it's applicable to everyone in this room. And that's why I like this. It's applicable to us because we're all consumers, right, of the insurance product, but also your clients. This is a hot topic on everyone's mind today. So we're going to get into some of that. And my goal, where's the clicker? My goal today is to, at the very end of this presentation, to be able to have you talk to your clients, talk to your family and your friends with some objective data and some objective facts of that age-old question of why is my insurance increasing? And we're going to talk both on a macro level, so throughout the country, as well as a micro level specifically to Colorado. So at the end, you're going to be an expert on these 5 topics, and you're going to be able to go through and explain that. So one of the questions we often get just on a macro level is, why are Colorado insurance premiums outpacing the rest of the country? And it's a really good question. And one of the main reasons is if you look at the Colorado combined ratio, and that's a nerdy insurance jargon for how much we pay on losses plus our expenses, go into our expense ratio. And in Colorado, the last 5 years, every dollar the insurance industry, this isn't just Chubb, this is insurance industry, every dollar that we've brought in, we've had to pay out $1.25. So that's 5 years in a row. I know this room's filled with a lot of brilliant financial minds. Not a lot of industries or companies can pay out 25 cents on the dollar 5 years in a row. And if you're wondering, how does Colorado shape up in the rest of the country? Colorado is at 125. The rest of the country is about 104 to 102, depending on the year. So for those of you that think that Colorado is paying the premium for Florida and California and Texas, we're actually outpacing those states by about 20 points on a 5-year combined basis. So that is causing a need in the insurance industry in Colorado. So at this point, insurance companies are kind of at a fork in the road. There's 2 directions we can go. One is to exit the Colorado market altogether. You've probably seen a lot of insurance carriers already do that. They either exit, they non-renew, they say we can't take new business, or the only other option is to get the adequate rate at the adequate terms. And I know that's the more painful way to do it, but it is the more of a long-term sustainable aspect. So we'll get into both those avenues and what's driving those. So what we're going to start with today is inflation. This is probably the most talked about in the media. It's probably what's freshly on your mind, especially the last year to year and a half, because it's impacted all industries, but specifically with the insurance industry, you can see the steep rises that we're seeing. And from a building perspective, every building material, excluding copper electrical, has inflated, and this is just on a year-over-year basis, by more than 10%. So if you're looking at this slide and this slide alone, what this is driving is at least a double-digit rate increase in the industry just based off of materials. And these numbers that we're looking at, this is a nationwide basis. These numbers would be substantially higher if one of two things. We live in a state where there's substantial population growth. It's going to cause an increase in supply and demand, or increase in demand. So these numbers for Colorado are probably significantly higher. And another thing that causes these to be higher is if your state has incurred a catastrophe event in the last year. So Florida and California, when you think about the Marshall wildfire, we had 1,000 homes lost, a little over, and we did not have 1,000 available homes for folks to move into. So these numbers, when you're thinking about on a nationwide basis, these Colorado numbers are probably significantly higher. So this is kind of the first table stake I want to put in the ground for us of if frequency does not increase. So if we have the same amount of claims in the insurance industry this year as we did last year, we'll already be needing at least 10%. Unfortunately, I think frequency is trending on an increase as well. So we'll get into that in a bit greater detail. But here's another thing. So we're just talking about the house on the last slide. It's important to consider the things that are inside your house because, like myself, I've accumulated the items in my house over decades. And quite often I'm thinking of the price I purchased it for. So there's a lot of folks, and we saw a lot of examples in the Marshall wildfire that were underinsured from a personal property perspective. So that's one thing just to think about. But the other thing is to think about how a high net worth carrier compares to the standard market. Because the way the Chubb product is, and a lot of the other folks in the high net worth market, is if you're looking at the Sub-Zero refrigerator here, it has increased 5% year over year. So that's only if you bought it last year, your home burns down, we have to replace it. Or if it was a few years ago, we actually replaced a lot of kitchen appliances due to hail claims because they were going through the skylight and completely obliterating entire kitchens. So this is a 1 year, year over year basis. But imagine if you have the 2000 version of the refrigerator. You probably bought that in the year 2000 for $5,000, $4,000. The way the Chubb contract works is we will replace it with the current year model. So if it's this year, it would be the 2023 model, which is probably $21,000, $22,000. So that's the thing when you're thinking about contents and when you're thinking about ensuring that your clients have that peace of mind to ensure that they're not going to be underinsured in those events. It's really important to know what the contract is and what they're going to replace it at, because we see a lot of these, the technology is increasing rapidly, which is causing a lot of increase. Labor is, this isn't new to anybody, but the cost of labor has increased significantly. This is on a construction basis. If I showed you some other industries, specifically the law industry, if you know any attorneys right now, it's a good time to be an attorney. So we'll talk about some liability and some of those trends. But this alone and the shortage of skilled labor, again, we're talking both macro and micro here. Macro level, this is a big deal. Colorado, this is an even bigger deal. And for anyone right now that's trying to hire folks, even in your industry, it's really hard. It's really hard to keep them. Insurance industry is not immune to that. So we talked a little bit about the impact of inflation on homes, how that's impacting clients, yourselves. Autos have not been immune. So you can see here some of the supply challenges, whether it's a lack of computer chips, plant slowdowns. If anyone bought a car recently, if you buy the 2023 model, I think they should give you a discount because you're not going to get it until 2024 anyway. So it's old news by the time it shows up. So it's causing a huge amount of shakeup within the insurance industry, and we're feeling it. You can see the average price of a car, that's $48,000. That's not a small amount of money. And some of that is based off that last slide. The technology in vehicles has increased so substantially that vehicles are a lot more expensive. And this is the average price of a car. If you're Chubb or a lot of the folks here that work with high net worth individuals, they're probably not buying the $48,000 car. We're talking much more substantial numbers. So I know myself, I complain about my auto premiums, $2,000 a year for a vehicle, but if you think about the cost of new cars and how much they're being totaled these days, how many years do you have to go claims free to pay for that if you do end up having to total a car? UBI, that's kind of a change of mindset, user-based insurance. This is something that Chubb identified during the COVID era. Clients wanted to see their auto premiums reflect their driving habits. I think that's really good for a lot of people. I think that's maybe not so good for folks like my wife that maybe don't need UBI. Don't tell her I said that. She actually works for the financial. She's a product manager for LPL. So if you work for LPL, don't tell her I said that. We can edit that out, right? So what we're doing, and this is Chubb looking for ways to help you and help your clients, is we're implementing this. We're going to be the first high net worth carrier starting at the end of the year to implement on an optional basis. We know not everybody is going to want to have their driving tracked and that type of thing, but for those that do opt in, you would get a between a 10 and 15% discount to your auto premiums, because I think we need more levers in the industry to help reduce and rescind some of that rate. Yes, sir. Exactly. Yes. That's the key. I do know that there's an option on there that after you drive, you can say that wasn't me driving, which we'll see how that works. Yeah, if you use it, yeah, once a day would probably be flagged. So here's what we're seeing for the average cost of repairs now. So we talked about the increased cost of vehicles, so that's causing an issue. But one thing that's hidden in the average cost of repairs is the amount of rental reimbursement that we're using. Historically, if we had a car wreck, let's say it's a fender bender, generally that's a $200 claim to fix the fender 10 years ago, but now there's sensors on it, so that 200 is 2,000. That's a huge multiple of what it used to be, but it's also taking significantly longer to get those cars out of the shop because there's a shortage of materials and supplies. So for a lot of insurance carriers, sometimes it's a $200 rental reimbursement with a 50-day per day cap. With Chubb, our policy is $15,000. It's built into the contract with no per day cap. That sounds like a lot of rental reimbursement, $15,000. It's actually not. We blow through that pretty quickly on most repairs, and I'm talking very simple repairs. We're utilizing all $15,000 of that rental reimbursement. So it's really driving up the cost. But another thing that's driving up the cost is the amount of total losses that we're incurring, and that's based off the increased technology. Cars are much more safe these days, but the reason they're more safe is they're almost built like accordions. Our auto guy at Chubb always says, if you drive down the road 10 years ago and there's a major accident, you'd see a big steel car with a few dents. And these days, if a car accident looks like the car just kind of fell apart, and that's by design to make sure the internal drivers are safe. But what is that doing to the car? It's totaled. So we're having to total far more cars than we've ever totaled in the past. And then we were joking around about how long it takes for cars to arrive after the total, then we went to reimbursement and the new car that has increased 17% since 2020. We're talking a lot of compound increases, which corresponds with the end customer. So we're seeing a whole lot of that. So this is a slide that I think my company, I probably drive my company nuts every year, because once a month I send them 2 questions. What are some of our top frequency when it comes to claims? And tell me, what are the emerging trends? What are we seeing that's happening this year that wasn't much of an issue last year? So top frequency, auto will always be there just because of the frequency. It is high severity, but we're talking glass and towing. We used to call that high frequency, low severity, because it happened a lot, but it didn't cost a lot. And now it's pretty close to say high frequency, high severity when we're talking $2,000 to $5,000 per windshield with a lot of the ones with sensors. So that's driving a lot of the top trends. Vehicle damage, we'll get into some really scary stats later on. But from a water damage perspective, this is one that I think will shock most of you. We hear a lot about wildfires. We hear a lot about floods, earthquakes. One thing we don't hear a lot in the news is the leaky toilet or the leaky sink. But did you know that 45%, and this is on an annual basis, this isn't just one shock loss. Every year, 45% of every claims dollar paid throughout the country comes from a leaky toilet, a leaky sink, leaky refrigerator. So we don't hear a lot about that. That's nearly half of every dollar comes from this. And this is something that can be fixed. Water shutoff devices were something that used to cost $2,500 to install, and you get a 3% discount, so it paid for itself in 15 years. Now, with technology, I've been giving technology a hard time, but this is one of the things that's helped is with technology. It's like, remember the big TVs that used to cost $30,000 and now you can get it for $200? The water shutoff devices are the same way. You can get one for $500 and you get an 8% discount, pays for itself nearly in the first year. So that's something that you can be sharing with your clients, because if you have a water loss in Colorado, you're probably going to get non-renewed, and you're probably going to have to get moved to another carrier that's going to charge 30 or 40% more. So I look at these as a long-term financial investment with the water shutoff devices. Theft is another one that intrigues me. Colorado, I think last year was the #1 state in auto thefts. Yes, sir. Okay. All the time. Yeah, it's a really good question. So generally, if it's a home or a standalone home, you put it just on the water main, on the other side of the residential sprinkler so that those can still go off. On a condo, you could put it just on the shoot off from the main water main just to your unit to ensure that you're protected. The key is you have to try to convince your neighbors above you to do some similar. Oh, so good. Yeah, and we see a lot of that, and those are not small claims when those occur. So there's and I brought a stack of cards too. So if anyone wants to delve into this in greater detail, I'd love to chat with you about it. I believe I'll stop by happy hour for a little bit too to chat with some of you. But yeah, really good question on the water claims, and we can get into that. Auto thefts, Colorado last year I think was the #1 state in auto thefts, which is crazy. And I lived in San Diego for 10 years, and when I was there, that was the #1 place for auto thefts. So I hope you locked your cars today. There's no correlation, I assure you. But it is ironic. Yeah. If there's the third state, then that would be a trend. We're not there yet. But excess liability is something that I think if you walk away with one thing to remember talking to your clients about, is excess liability. It's one of the most cost-effective ways to protect wealth, and it's one of the quickest ways to lose what you worked a lifetime to accrue. And then rec marine, I know we're not a coastal state, but we'll get into some stats on that. So what's changing? A lot is changing in the marketplace. As Carrie mentioned, I've been in the insurance industry and the high net worth insurance industry for 15 years. That pales in comparison to a lot of my peers and counterparts. And I've asked a lot of those folks that have been doing this for 40 years, 4 decades. And they said that these last 2 years have been the most change and the most difficult market they've experienced in the previous 40 years. There's a lot going on in the marketplace. Some of it is what we just discussed, but some of it we'll get into in greater detail. Now, this is the part when I say I'm a bit of an insurance nerd and I get a little too excited. This might be the spot you have to stop me or maybe pull me aside after, because we're going to get into a challenging topic. I'm going to try to keep it high level, and I can discuss it later. But Reinsurance, when we talk about why are rates going up? Why are carriers leaving the state? And we hear wildfire, we hear water losses. There's not a lot of insurance articles or news media outlets blaming reinsurance. You probably never heard of reinsurance. Reinsurance is insurance for insurance carriers. So Chubb insures the client, reinsurance insures us. And the way this works, because reinsurance is a vital part in the insurance industry. The way this works is it allows insurance carriers to have greater capacity. So what we do is we pick a number, maybe it's $100 million, and we say if any loss occurs over $100 million, the reinsurance carrier will pay for all of the rest of the claims. So that allows us to have steady rates, to have steady financial records, and it allows our stockholders to feel much more comfortable in what we do. So any changes to reinsurance changes rates, changes financial ratings. And last year, for the first time ever, insurers have been having a hard time. They've increased the attachment point, which is like a deductible. So instead of covering everything over 100 million, now it's 200, maybe it's 300. So you're thinking, oh, well, that's more exposure, so it's probably lower price. No, it is double the price. So this room is full of some brilliant individuals, and I think you know what occurs when somebody doubles the price. There's a trickle-down effect to the carrier, to the client. So this is something that isn't talked about a lot, but man, is it impactful. And I did want to put that on your radar today. So here's another thing that is driving claims rates throughout the country. Clients are moving into harm's way. We've always had catastrophe events, wildfires, hurricanes, floods. We've never had so many people living in those areas. So you can see Florida, the Gulf Coast, the eastern part of New York, Seattle, which is having more fires than I think any state this year. And then you see our beautiful state of Colorado. So people are moving in. So when we're having these catastrophe events, more people are being impacted. Here's another nerdy insurance jargon, ENS, excess and surplus. You can see as we're talking trends, anything that is a 250% increase, that's a trend. So ENS means excess and surplus. Similar to the financial industry, the insurance industry is a highly regulated industry. So generally, the state will regulate how much you can increase rates, how many people you can non-renew, what coverages you give. With excess and surplus, it's almost like an a la carte coverage. So an insurance carrier can say, here's what our filed rates are, but your exposure is so unique that we're going to have to charge this. We're going to have to maybe reduce this coverage. It's more a la carte to that specific exposure. And historically, this has been reserved for Florida, Texas, and California because it hasn't been needed anywhere else. But now you can see Colorado and Minnesota. There's a lot of states that are growing because no insurance carrier on the admitted side is able to provide terms at a price that they feel is long-term and more sustainable. So this is something that you're going to hear a lot in the marketplace going forward. So let's talk weather. These are billion-dollar disasters, and I know that that's a lot. So I'm just going to show you the map. And what I want to draw your attention to is, if you recall the last slide, where were Americans moving into? Florida, Northeast, Colorado. We didn't have the Marshall listed here because it ended so at the very end of 22. It was a billion-dollar disaster, so it deserves to be there. California. So you can see people are moving into the states and the areas that we're having our biggest disasters. And so these are just the billion-dollar events. And when I say billion-dollar events, I don't mean they generally ended around 1 to 2 billion. Some of these were in the hundreds of billions for one event. So historically, we haven't had this type of shock losses. So when we have these types of shock losses, in addition to, as we're talking about reinsurance, taking on more of exposure with the carrier, it's going to be impactful. It's probably going to be impactful for the long term. So hurricanes and wildfires, I did want to touch on this just because it's what we see in the news, it's what we talk about. And you can see the bar graph. The blue bar graph is the numbers of acres burned, and it's staying fairly consistent. So the question is, if acres burned aren't increasing, why are we having so much increased losses, so many billion-dollar disasters? And that goes back to the slide where more folks are moving into those wildfire areas. There's this urban, we call urban conflagration now. The fires are coming in from wildfire areas, and just like Marshall, where that's not technically considered a wildfire area, but those areas are being impacted. 7.3 million. But this is the one I wanted to show you, I wanted to talk to you about, because it's not talked about as often in the media, but 75% of all federal disasters are flood. And this is something that I think clients in Colorado need to know, because flooding events happen in states where there's a large amount of growth. Because what occurs is the water pattern used to flow this way, and now there's a subdivision. It's not proven what that's going to react like in the next storm. So we have a lot of that. We had a lot of wildfires, so where there was vegetation before, there might not be now. And not a lot of Colorado clients have a flood policy. And it's a good way to lose a significant amount of net worth. For those of us that were in Colorado in, I believe, 2012, when Boulder flooded, nobody thought Boulder would flood. And even the homes up in the low foothills, those were impacted by a flood. So this is a big topic, and I think it's one that, as a group, we should be able to spread the word and protect your clients. So not only are there changes in the marketplace, there are shifts in passion. We're seeing a lot of changes from our clientele. And this is the slide I tried to hide from my wife. Jewelry sales are increasing significantly, 25%. Art is appreciating at a huge value. One thing I found interesting is pre-pandemic, a lot of these auctions had to be in person. So you had to pick a venue, people had to show up. So they weren't as often. Now 25% of all auctions are now online. So they're happening more frequently, which is driving up values. But also an interesting nuance that I just heard is, with the online auctions, you're allowed to make comments below. And when people are commenting, oh, I saw that ring worn by this celebrity, or I saw that art at this museum, those comments are creating a bit of a frenzy, and it's driving up rates. So not only are more happening, but when they're happening, it's driving up rates. And this is not a surprise to anyone. There's a huge demand for watches, luxury handbags, the sports memorabilia one. That's still a tough subject for me. That was my passion growing up. I grew up in the glory area of the NBA. I had so many rookie Jordans and Shaqs and Birds, and went to San Diego for work after college. And when I moved back to Colorado, I asked my mom for where the cards were, and she said Goodwill. So that one still hurts me. But for whoever bought those at a discount, is making us some significant money. But these are things that quite often your clients own, and they think they're covered under their personal property, but quite often there's sublimits. So that's a sublimit in an insurance contract. Is jewelry is a good example. A lot of people don't know that jewelry is capped at $2,500 or $5,000, depending on what contract you have. So there's a lot of people that have $100,000 of jewelry, and maybe it's just one ring and they lose it, and they don't realize it's subject to the deductible and capped at $2,500. So it's important to get that standalone jewelry policy, because not only is it uncapped, you can list it at whatever you want, and it gets market appreciation, but it's no deductible and it's worldwide coverage. So that's a really good topic to be sharing with your clients. So here's where we get into the voting, and I mentioned we're not a coastal community. That said, during 2020 and 2021, Colorado saw their largest growth from what we call personal watercraft, which is 26 feet and under, almost in history. So there's a huge amount of new boats out on the lake. If you don't believe me, go to the lake and see how crowded it is. But the scary part is most of those boat purchases were from first-time boat owners and a very young demographic. So if you go to a lake and you have a spare 30 minutes and you either need a laugh or something to scare you, go to the loading and unloading section and just watch somebody try to unload their boat, and then to think they're going to be out there buzzing around the lake. So what we're seeing in Colorado is a huge increase in liability and medical payments on a boat perspective. You would think we live in a coastal state, the amount of frequency and severity we're getting on wreck marine. And there's a stat of 145% increase of ages 18 to 44 that are purchasing these boats. That's a young group, and it's historically not been that way. So liability, this is the section here that I think is most impactful for everybody, myself included. We live in a state that we have a lot of folks moving in. We have a lot of underinsured and uninsured motorists on the road. I think Colorado is a top 10 state now from an uninsured perspective, and I would love to see what the stats are for underinsured, so state minimums. I'm scared if I saw that, I would probably just be taking the light rail all the way down here. So here's things that we're seeing. We're seeing pet ownership. Remember when I mentioned that slide of the billion-dollar disasters? Last year was the first year that there was ever $1 billion combined in dog bite claims. So that should be on there, is an angry dog, or maybe not an angry dog. But we're seeing a lot of that because we talked about during the pandemic a huge influx of boat purchases. We saw similar with pet ownership, because you're home, you need a companion, you got a pet, and now it's 3 years later and you're not quite sure if you still want that pet. And I think we have a lot of maybe not so great dog owners, and it's causing a huge increase. Auto severity is increasing. We're going to talk a little bit about why. From the litigation standpoint, I think our tort system will never be the same. Both frequency and severity, talk a little bit about social inflation as well. So here's a really sad stat. You can see the amount of fatalities that have been increasing over the past years. 2021 was a really, really bad year. In 2022, thankfully, these things are long tail from reporting, so we don't have the full details. It's anticipating that will trend to be lower, but you can see that it is still outpacing the last 10 years pretty significantly. And you can see what's driving some of that. I think mainly it's distracted driving. I heard a stat the other day that if you look down at your phone while going 65 miles an hour, and just look at it for 5 seconds, you will have traveled an entire football field without looking at the road, which is terrifying. That's just 5 seconds. So you see a lot of that on the road. It's hard to drive up and down I-25 without seeing some sort of accident. And the way cars are built these days, there's not a lot of small accidents, which is good. So here's what we're seeing in our book of business. Chubb has been in this industry for 35 plus years as a $6 billion book of business. So we see a lot of claims. We see a lot of what's going on. And we're seeing a huge increase in the amount of payouts. And a lot of it is driven by emotional distress. The new vehicles that we mentioned in 2020, there's a lot of new vehicles purchased. A lot of the new cars, especially electric, are very, very fast, have a lot of torque, and are very expensive. But the litigation funding companies, I joked earlier that if you have attorney friends, it's a good time to be an attorney. There's a lot of changes in this marketplace that are changing the way that insurance payments are paid out and the amount of insurance that are paid out, and we'll get into that. So here, and this is not to scare you, I just wanted to show some real life examples of claims that we've experienced. And this is why I said I think liability is the most important topic for us, because it's if you look back into the Marshall Fire, there's a lot of sad stories where people were underinsured on their property values, and they had to pay out tens of thousands of dollars out of their bank account, which is a terrible day. But from a liability perspective, you could be paying out millions of dollars if you're not taken care of properly. And it's a misnomer that when you tell a client, listen, you need $5 million or $10 million of excess liability, that sounds like a huge number. And it also sounds like it's going to be very, very expensive, but it's very cost effective. The $5 million, which would cover almost every claim on the screen here, is going to run you about $500 to $800 per year, depending on youthful drivers and cars. It also gives you $1 million of underinsured and uninsured motorist coverage, because that to me is the scariest part. Is if somebody runs into my car and they have $25,000 of property damage and $100,000 of liability, and I can't work for a few years, that's not going to be enough, and it probably won't be enough for your clients. So $5 million, or around $500 to $800, is certainly well worth it. It gives you that peace of mind. So these are some new trends that a lot of, when we're making large payouts, it's largely based on some of these new factors that are pulled into litigation suits. And what we're seeing is that the litigation funding companies that we're going up against, historically, if there is an insurance claim, most insurance carriers will make a settlement. They won't go to court, they'll make a settlement. These companies aren't accepting settlements. They want a jury, and they want to try to get their clients significant amounts of money. So it's certainly bogging up the process. So just to bring it all together, I told you at the start, my goal was at the end, for when your clients say, why are insurance premiums going up? Are they going to get better? What are some of my top exposures? I hope that is something that you feel comfortable talking about. I hope if you have any questions, to talk to me about anything you want, whether it's water shutoff devices. So I wanted to end with just some of the main differences between a high net worth insurance carrier and standard, because there are some significant differences. I think the insurance industry, we get a bit of a bad rap where it's a bit of a commodity. If you're paying more than your neighbor, you're probably doing it wrong. But the truth of the matter is that it's not apples to apples. There's a lot of, one time I looked it up, there's a lot of different varieties of apples out there, if you really delve into it. So part of the Chubb apple is we try to make it a lifestyle, because we understand that we are insuring successful individuals that have done well for themselves in life, but they don't have a lot of time to sit on hold, press 1, press 2, or to find their own service provider. So whether a client needs a jewelry appraisal, maybe they've had a roof claim and they need a claims adjuster, we have 3,000 trusted providers that are highly vetted. Generally, these providers give extended warranties complimentary as being a part of this. So that's just one of the lifestyle benefits, the peace of mind that you can get. 24,000, or sometimes it feels like 24,000, 2,400 claims professionals. And this is just in North America. Chubb is in 52 countries. And the reason why that's important is we know our clients like to travel. And it's important to have boots on the ground that knows the local regulations, the local customs, and can meet clients in person and give them that white glove treatment. Digital capability. And I'm looking very closely to see if anyone's rolling their eyes, because insurance is not known for being excellent at digital or technology, but it's something that we're really investing heavily in Chubb. It is something that we're doing with claims. You can send in a claim from the phone, you send in the picture, you get the invoice, and the payment comes EFT straight away, which is pretty cool. Aerial imagery, I think that's a really cool thing. And it's pretty revolutionary because the way the insurance industry works, and it's just the way it is it's incumbent on the client to prove there was damage or a claim that's covered before the carrier responds. Now, the kicker is when there's a flood or a hurricane or a fire, the local municipalities won't allow clients into their neighborhoods. So they have to prove there's a claim, yet they can't go into that neighborhood. So what Chubb started doing, and we started it during Harvey, during the hurricanes out there, is we started flying drones into these communities. We would fly our drone in, and if we saw there's any water next to your home, we just assumed that your whole first floor is wrecked. So we would write you out a check for contents. We would put you in additional living expenses so that we can get the claims process started. And the reason that's important is let's think back to the Marshall Fire. Over 1,000 homes lost. There's not 1,000 homes in Colorado ready and available in the Boulder area that we can just put people in. So Chubb was able to get in there early, find if there was damage. And the good news is if you get in and you realize it's not damaged, you can reach out to the client and say, hey, good news. I know you've been worried about this. It's not damaged. But what's even more important is if it is damaged, we know that they're going to need a replacement home. So, and we have the full list. So our clients get first pick at the homes that are in their area because we try our best to keep you on the same school bus route in the same school district to make your life a little easier throughout that process. And then one other thing I did want to share, I was thinking about some of my favorite things about the high net worth industry and what makes it different. One of them is at Chubb, we have a thing called Wildfire Defense Services. That's essentially like a private firefighting force that can help protect clients, can protect homes. And we deploy these individuals. They're on retainer for Chubb on any major fire. Probably a lot of them are in Colorado right now, just waiting for a fire to pop up. And when that does, what they do is they go to your home. And I know a lot of clients think if a fire happens, I know exactly what I'll do. I'll put on my exterior sprinklers and I'll leave my house. And what they don't realize is that during a fire event, the fire department will actually shut down water pressure for everybody so that they have sufficient. So what we do is we will go and we'll set up an above ground swimming pool, which kind of looks funny when you show up during a fire and start setting up a swimming pool, but it's not the plan. And what we do is it's substantial water so that it has the sprinklers. We'll put a couple on your roof, a couple around your house, and it can run for up to 5 hours so that when the fire rolls through it and the embers are rolling down, that home will be protected for the duration of that fire. On extreme cases, we do have a environmentally friendly thermo gel that we'll spray your house with. It will not damage the house. It's actually so healthy that I've threatened to eat a little bit of it just to prove it. But our firefighters told me that one pea-sized aspect of the gel, once it got in your body and the liquid hit it, would expand to the size of a basketball. So I'm glad they told me before. But it is environmentally friendly, and we will spray houses. So when you see the aerial images of entire neighborhoods that have been wiped out, and there's one home that's untouched, and the grass is still green, that's probably the homes that we've utilized those on. And then after the event, we'll go and clean it up, put your outdoor furniture back to your home and make sure everything's good. So there's a lot of nuances and a lot of things that are different. And if you want to chat about those in greater detail, I'll leave my cards here and feel free to grab me at happy hour. I'm happy to. Yes, Craig. That's a really good question. We will write dwelling values that start at 500,000, but our sweet spot is generally once the home gets to about $1 million is when we're talking the Chubb clientele, and then we're going to be most competitive if they put the home and auto and jewelry with us. And umbrella, you were listening. Thank you, Craig. And how much umbrella do they need, Craig? At least 5 million. There you go. Thank you. Yes. Mm-hmm. Mm-hmm. No. And the reason for that is part of why all carriers have exited California is, remember I was saying the fork in the road? You either exit the state or you get appropriate rate. Colorado, we're allowed to charge the appropriate premium, which is why you're probably experiencing increases. California government did not allow the necessary rate increases. So if carriers were going to lose money, they either had to leave or not. So I think the fact that we can charge appropriate rates here won't lead carriers to have that mass exodus. That's only if she finds out. They always find out. All right. Should I call her on speakerphone right now? Is that what we should do? Yeah, that's good question. Thanks for bringing that up. I think one of the major benefits with Chubb is we don't have a ton of endorsements because everything's built in, mold being one of those. A lot of direct writers, you would have to drop down and select $10,000 of mold coverage, which comes with a huge amount of premium increase. That's just built into the Chubb policy. So that's the peace of mind we're talking of. If there's a claim, it's covered. But there are endorsements such as EPLI, which is Employers Practice Liability. And that's where we have a lot of clients that have domestic employees, the nannies, the housekeeper. And for that, not only can we insure against claims that occur there, but we also, every Chubb client gets one complimentary background check. So as you're hiring those folks, I did check. If it's your daughter's prom date, you cannot use your background check. But if it's a housekeeper or nanny, you can get the background check that does the DMV, the criminal search, all that type of stuff. Equipment breakdown, you can add on. Flood is endorsed directly to the policy rather than a lot of carriers have to go out and get the national program, which is not as robust, because the way a lot of floods work, and we're talking how important that is, generally you cannot submit a covered flood claim unless a certain amount of acreage was impacted and a certain amount of individuals around you were impacted. With Chubb, you could be the only house that was impacted. So just your property could flood and you're still covered, which is very different. So backup is built in. It's one of those things that once it's there, when a claim happens, you can kind of breathe easy and rest assured. Yes, sir. Publicly held. I think we're Forbes 300. Yes, sir. Mm-hmm. I don't, that's kind of the scary part. I don't see a lot of legislation going on. I think what we're going to see, at least in the short term, is due to the amount of high verdicts, which you just mentioned, I think we're going to probably see a greater influx in folks trying to get into that industry, which will drive a spike, which might actually lead to that litigation at the end of the day. But I don't see anything in the short term. Scary. Yes, sir.
Not to close it off with kind of a more in, but I'm also on the note that so I'm just trying to understand more about what happens when insurance carriers start leaving other states besides California and say.
I think what's more likely is California was a really good test study of what happens if the state tries to set the rates. I think what's going to happen more often is carriers are going to be able to charge the appropriate rate. Now, what that's going to be is it's going to be a lot of pain for us as the consumer in the short term, but it just, you can't keep losing 25 cents on the dollar for 5 years. That's got to change to stay in business. I think higher deductibles, I think that'll be a big trend. I think not only are you going to have forced higher normal deductibles, I think all of us Coloradans are going to have a wind hail deductible, potentially a wildfire deductible. And I'm saying not even if you're in Aspen, and anywhere can burn as Marshall. So I think self-retention is going to be a big thing in the future.
How does Chubb as a company take a look at their clients' replacement patterns?
Oh, good question. Yeah.
So for a lot of, I've seen a lot of my clients on my annual reviews now, I write liability insurance and replacement coverage.
I love it.
Because I went through a situation where I was with auto owners. I live on an open space, but I thought I didn't get my insurance redone, so I went through a little checklist with my agent. Supposed to go by 40 grand, so did that. Triggered an audit by auto owners. They sent somebody out. I had to do another paper, and she went through my whole house in about 2 hours. Right. 2 weeks later, they tell me to increase it in addition to on top of 40,000 I requested. So I'm recommending my clients always do that, because now if my house burns down, you told me what it was worth.
Yep.
Replace with that.
Yeah, it's a hot topic right now, right? So the way Chubb does it is we have very tenured, what we call risk consultants that will come to your house. We see every home, and it's not just to verify values, it's to help with risk management. But what we do is each risk consultant in the state has to interview, I can't remember the exact number, but they actually have to interview 10 electricians, 10 GMs to make sure we're dialed in exactly on zip code basis. So we can value your home, but the benefit to the Chubb policy is it's called guaranteed replacement. So if we insure a home for $1 million and it burns down and we can't replace it for anything under $100 million, we would pay $100 million. And we've had some instances where I think we had one where a home burnt down and we thought it was a regular tile roof, but we found out the tile was from a quarry in Belgium that fell over and they used it. So we didn't know that up front, but now that we know, we're going to replace it with same like kind of quality from Belgium. So it's the guaranteed replacement cost is a huge aspect, because when you're talking about those inflation numbers, most homes aren't inflating their dwelling values that often. But with Chubb, you can rest assured it would be.
Other insurance companies, you know that property values have gone up enormous amounts. How do you ensure that the client is properly insured? Because clients I've run into, they haven't had a review in 5 years. They're probably dramatically insured. We saw that in the Marshall fire, where people were rebuilding their homes, $1 million home, they got $800,000 back. They got a $400,000 grand just to build a home like that. Used to be 16, 17 years.
Yeah. A lot of carriers, they have an inflation built in where the home will increase in value 3% a year, but it hasn't been keeping up. And the hard part is the 3% inflation is based off of just your home burns down. If your whole neighborhood burns down, that's going to increase the cost of labor and materials. So with those big events like Marshall, it's hard to be insured properly. Yeah.
So remediation with asbestos or gas, they're not covered. So they, the homeowner that that part of it, which is
It can be, yeah. It's from the Chubb perspective, and every claim is looked at differently. But if it's a covered peril, we spend a lot of money on getting the smoke smell out, or replacing floors, and a lot of remediation type. Probably the folks that that had to pay a lot were, unfortunately, with Marshall, it snowed and then it froze, and the electricity was off, so pipes burst, and then mold came, and it just a lot went on in a short amount of time. Then let's say you have a $10 million home policy, and we see this a lot because it's traumatic, right? If your home gets burnt down, we'll just cut you a check and let you go wherever you want. And that's built in.
Final call for questions? So. I think the main takeaway is if your clients are complaining about their rates, you can blame Ryan or call Ryan. So we'll take a quick 15-minute break. We'll start our next breakout at 2:15.
Check.
Oh, that's nice.